Hello and welcome everyone to Onchain Reaction. I'm your host James Bennett, and today we're going to be diving into what's happening on Bitcoin on and off the chain, as well as a bit of DeFi. Okay, so let's jump right into it. It's been one hell of a week, to put it bluntly. Bitcoin has tumbled down from a high of around $64,000 just a few weeks ago, today trading at $38,000. And really it's been a sequence of events that has led to this sharp correction in Bitcoin's price. So here I'm just going to walk you through some of the key events that we've seen happen. 27th of April was when Tesla started to mention that they were selling some of their Bitcoin holding, 10% of it, to test liquidity. By the 5th of May, we saw that Bitcoin funds, that's the amount of Bitcoin held in all the different investment funds across Europe and the US, had peaked and started to sell over 7,000 Bitcoins. Now, it was at 11th of May, where we had the big first drop, which was partly attributable to miners starting to sell a lot of inventory into a weak market. By the 13th of May, Elon Musk came out and said that Bitcoin used too much energy, an insane amount, and we expect that at that point they would have sold the Tesla Bitcoin, but we'll see that when they produce their Q2 reports. The other thing that happened was that Binance is under investigation from the US for its Cayman activities. Supposedly, US investors are hiding taxes related to crypto offshore. By the 18th of May, we'd now tumbled into the $40,000 range, and the Office for the Comptroller of Currency, that did some fantastic work last year under Brian Brooks, came back and said, right, we're going to review the existing guidance for those 3 landmark regulations that were passed towards the end of last year, which isn't great news, although it's probably just words at this point. It didn't help the fact that Brian Brooks did leave the OCC and went straight to Binance in the US. So it does raise an eye or two. We think he has the best intentions and is really trying to push this industry forward in the way that it should be done. What else happened on the 18th of May? Well, China back in the mix again, banning financial and payment institutions from using crypto, and then also this tax announcement from the Treasury Secretary Janet Yellen, who said that transfers over $10,000 in crypto value should be disclosed to the IRS. A few days later, we then had China come back on the scene again and announce a ban on Bitcoin mining. They've really gone anti-crypto this time, probably for the 6th or 7th time. This has been reported over the last few years, but this time apparently is different and it's for real. Anyway, look, fundamentally, Bitcoin remains the same network that it has always been, if not just stronger from going through this sort of insane volatility. But the outlook is very much still positive, and Bitcoin isn't going anywhere. Okay, so I'm going to whiz through a few of those points on that timeline in a little bit more detail. I'm going to start with funds. So here you're looking in orange at the total number of Bitcoin held by funds, and you can see it peaked around the 5th of May. Shortly before the price started to tumble, we had the longest or highest amount of outflows in BTC terms from the 5th of May until now. You can see that downward slope in the top right of the chart, and price responded. Looking at closed-end funds, now these are the types of funds that can't actually release Bitcoin from their investment vehicles, but they can trade at a discount to their net asset value, which means at a 20% discount, as we can see with Grayscale today, investors holding the GBTC product are saying actually it's worth 80% of a Bitcoin, partly because of its liquidity. And you can see in the table underneath, there are 3 main sort of big vehicles that remain as the closed-ended funds, and those are 3iQ, Grayscale, and Osprey, all of which have not seen any inflows this month for the first time since we've been taking the history. This is all available, by the way, on ByteTree Asset Management under our data. Okay, next one, slightly controversial. Bitcoin has been dubbed as digital gold many times, and I just wanted to raise your attention to the volatility, a 30-day annualized volatility, comparing Bitcoin in blue and the physical gold, the commodity gold, the gold shiny metal in orange there. And look, the picture is the macro scene is slightly chaotic, let's say, very high expectations of inflation. We've seen, potentially the Fed may respond to that with inflation inflation running now at about 4.5% in the US, quite a lot above that sort of loose boundary of 2% that the FOMC targeted earlier this year. And so what's happening? Well, investors are moving towards gold at the moment, and gold has seen a 3-month high and volatility is falling, but they're moving away from those sort of racy tech stocks. Nasdaq is down, I think, about 20-30% last time of checking, and from a high earlier in January, and we're seeing, of course, Bitcoin is also suffering a similar fate. Okay, so a couple of on-chain charts here. We're looking now at the block times for Bitcoin. Now, why this is significant is because, as I mentioned, China have supposedly banned Bitcoin mining, which is a huge part of the hash power that's been contributing to the Bitcoin network. And with that going offline, the amount of work being done on the network has dropped significantly, leading to an increase in block times. So we're about 7 days out at the moment from the next difficulty adjustment, and you can see here in red what the last 7 days has done or I should say 3 or 4 days has done to the block times. When we're in the red, it means we are going slower, less blocks than would normally be issued on the network, and when we're going in the green, it means we're running faster. There was that sort of spike in late April that was attributable to the power outage in China, and you can see again a similar pattern now in May. So look, the Bitcoin network adjusts every 2010 blocks, the difficulty level. So this is not a long-term problem, but I think it will mean that fees are going to rise again in the short run, and we'll probably not see that difficulty currently pegged for Sunday, but probably won't see it until quite a few days after, but we'll be looking out for that carefully. Okay, miners, I mentioned, had been selling hard into a weak market, an already weak market. You can see here in blue total miner inventories, and you can see that trend down in the right third of the chart here has really been following price. So that's to suggest that really miner selling has exacerbated a weak market and exaggerated the fall in price, and there's a very strong visual correlation that you can see there. Inventories, incidentally, are now at an all-time low level. We've never seen so few Bitcoins sitting in miner inventories. Right, this wouldn't be a full market roundup unless we touched on decentralized finance, and it's been a really interesting journey for DeFi over the last sort of 6 months or so. And now, with I think we had about 20+ billion loans outstanding, and now we're starting to see how those loans are dealing with much higher volatility in the market, which is a really important test for this future of finance service that these protocols are providing. So what we've seen is relatively positive. I mean, as you would expect, a huge amount of tightening in the market, with $4.4 billion of loans repaid in 7 days. You can see on that chart on the left, the first big blue spike down about 5 from the right. That's the 19th of May, when we saw the initial sort of big sell-off in the markets. And then again, yesterday, you can see was another big day of tightening with loans being repaid. Currently, Compound leads in that table on the right hand side in terms of total loans outstanding, about 4 billion closely followed by Aave, and then MakerDAO is there as well. But you know, with the three of them, they are continuing to serve the crypto ecosystem as banks, even during this volatile time. Okay, the last chart here is just to have a little bit of a look at the distribution of those loans across the different coins and tokens, I should say, that are available through the protocols. I've highlighted Compound here as the biggest market, and you can really see the yellow there is DAI and the blue is USDC. So these are dollar denominated stable coins, DAI being decentralized, USDC being centralized. And that has been the sort of main, they have been the main two assets that borrowers have been repaying during this time of volatility. Anyway, I hope that your last couple of weeks or week haven't been too bad, and remember that this industry is very much still alive and we are continuing to build and move forward. So keep your chin up and have a great week. We'll see you next time.